Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex world of business and finance. Today, we're diving into Worksport Ltd's latest quarterly report. And let me tell you, there are some interesting numbers in here that paint a picture of a company in a very interesting phase. Also, before we dive in real deep, if you like getting the inside scoop on what companies are truly up to, make sure you are subscribed. And if you want to, engage with a community of fellow financial sleuths. Join our Discord channel linked in the description below. So Worksport Ltd has put out their quarterly report for the period ending the 30th of September 2025, and it's quite a read. It's like looking into the engine room of a company that is trying to grow and adapt in a fast-changing market. Let's start by glancing at the balance sheet. Things like cash and inventory tell us a lot about a company's immediate health. On the 30th of September 2025, Worksport had about $3.7 million in cash. That is down from about $4.8 million at the end of 2024. So they are spending money, which is not unusual for a growing company. They also had growing inventory, about $6.8 million worth compared to $5.1 million. That suggests they expect to sell more. Or perhaps they are holding on to more raw materials to keep production going. Now look at their liabilities. Their accounts payable, roughly $2.8 million at the end of September 2025, has nearly doubled from about $1.5 million at the end of 2024. This often means they are buying more from their suppliers on credit, which can be a sign of growth, but also something to watch if it gets too high. One thing that stands out is their shareholder equity section, specifically the share subscriptions receivable, which is a negative number around $12,000. This can indicate that some customers have agreed to buy stock but have not fully paid. Yet it is a bit unusual to see it so large. Now for the part that really shows how the business is performing, the income statement, or as they call it, the statement of operations and comprehensive loss for the 3 months, ending the 30th of September 2025, net sales were about $5 million, up significantly from $3.1 million in the same period. Last year, that's a good jump, a 61% increase. They are selling more stuff. But here is where it gets interesting. Cost of sales also went up, but not as much as sales, so their gross profit, the money left after paying for the goods sold, jumped from about $247,000 in the third quarter of 2024 to almost $1.6 million in the same quarter of 2025. This is a huge improvement at 31.3% gross margin versus just 7.9% last year. That signals they are getting much more efficient at producing their products. However, their operating expenses are also significantly higher. They spent about $2.3 million on sales and marketing in the third quarter of 2025 compared to only $661,000 last year. This is a massive increase, a 257% jump. They are clearly investing heavily in getting the word out and selling their products. The general and administrative expenses also climbed quite a bit, which is typical when a company is growing, and all of this spending means their net loss widened for the third quarter of 2025. The net loss was about $4.9 million compared to about $4.1 million in the same period last year. So while sales and gross profit are looking much better, the increased expenses are eating up a good chunk of that improvement. What is also notable is the huge increase in the weighted average number of shares. They went from about 2.9 million shares in the third quarter of 2024 to 6.5 million shares in the third quarter of 2025. That means they've been issuing a lot more stock, likely to fund all this growth, and spending diluting existing shareholders somewhat. Looking at the statement of shareholders' equity gives us a visual of how the company's ownership structure is changing. We see a lot of activity here with share issuances and preferred stock changes. The increase in additional paid-in capital from about $79.7 million at the end of 2024 to about $95.7 million at the end of September. 20 shows they have been raising a lot of money through stock sales. And again, that share subscriptions receivable takes a hit, becoming more negative. This suggests a disconnect between selling equity and actually receiving the cash for it. There are also quite a few entries regarding Series C preferred shares being issued and then converted into common stock. This is part of their strategy to bring in capital and then turn that preferred financing into common equity for investors. The cash flow statement is critical for understanding where the money is actually coming from, and going for the first 9 months of 2025, Worksport used $11.1 million in operating activities. That is a lot of cash being burned to run the business. In investing activities, they spent $1.067 million mainly on property equipment. And intangible assets, this means they are investing in their future capability. Financing activities show they brought in $11.1 million through various means, including warrant exercises, and raising debt. This section really highlights how much they are relying on external financing to keep the lights on and grow. The net cash provided by financing activities is a positive $11.1 million for the first 9 months of 2025. This is a huge inflow of cash, and it directly contrasts with the large outflow from operations, showing how vital financing is for them. Now let's dig into the notes. These are the fine print that explain the numbers. For example, Note 2 going concern raises a red flag. It talks about the company not generating profit since inception, and relying on financing. They acknowledge substantial doubt about their ability to continue as a going concern, which is a serious statement. This means the auditors are not fully confident they can keep operating without significant new funding or success. They mention that operational costs are expected to remain elevated even though they bought manufacturing machinery. This is a common challenge for growing companies. They invest in the future, but the short-term costs are high. The notes detail numerous stock and warrant offerings. A registered direct offering in November 2023, raising over $4 million, is just one example. They are constantly working to get cash into the business. Under Note 3 inventory, they are holding about $6.8 million of it, broken down into raw materials. Finished goods and work in progress, this is up from $5.1 million at the end of the previous year. Note 4 sheds light on their property and equipment situation, showing a carrying value of about $13.2 million. This includes buildings, manufacturing equipment, and land. They have been depreciating this over time, which is normal. Note 5 talks about their intangible assets like software patents and trademarks, totaling about $1.04 million net of amortization. This shows they are investing in intellectual property, which is good for long-term competitive advantage. Note 12 details their lease liabilities. They have obligations for office space. The current portion alone is about $110,000, and the long-term portion is about $189,000. They have signed new leases in 2025, suggesting expansion plans. Note 13 on indebtedness reveals they have a revolving credit facility of $6 million drawn down to about $1.5 million at the 30th of September 2025, and another credit facility totaling $1.487 million. They are using debt to finance operations and growth. Under the loss per S-Hair section, they show a loss per S-Hair of 75 cents for the third quarter of 2025, down from $1.40 last year. This might seem like good news, but remember the overall net loss widened because there are more shares outstanding. Note 15 on warrants is quite extensive. It details numerous warrant issuances and exercises, showing a lot of activity in their equity structure. They are actively using warrants to raise capital and incentivize investors. Note 16 on equity compensation reveals they have granted a significant number of stock options and performance share units to employees, directors, and officers. This is a common way for growing companies to attract and retain talent, but it also represents future dilution for shareholders. Finally, Note 17 on segment reporting shows they operate in two main areas: hard tonneau covers and soft tonneau covers. The hard tonneau covers segment is by far the larger revenue generator, accounting for almost all their sales. The soft tonneau covers segment is much smaller. Corporate eliminations and other expenses are significant, which is expected for a company of this size. Looking at the revenue breakdown for the 9 months ended the 30th of September 2025, their sales from hard tonneau covers were over $10.9 million, while soft tonneau covers brought in only about $376,000. This clearly shows where their focus and success lies. The United States is their primary market, accounting for $11.2 million in net sales for the first 9 months of 2025, compared to about $5.4 million in the same period last year. That is a massive 106% increase in their home market. Now for our take on Worksport Ltd based on this report. They are in a critical growth phase. They are doing a lot of things right, like increasing sales and improving gross margin, which is a huge step forward. Their investment in production and intellectual property suggests a commitment to long-term viability. The significant increase in distribution channels and dealer partnerships is also a positive indicator. However, the company is burning through cash at an alarming rate. Their reliance on debt and equity financing is substantial, and the audit concern about their ability to continue as a going concern cannot be ignored. This means they need to keep raising money or achieve profitability very soon to avoid serious financial trouble. They're expanding operating expenses, particularly in sales and marketing. While necessary for growth, also contribute to the widening net loss. The large number of outstanding warrants and stock options also mean potential future dilution for current shareholders. In essence, Worksport is playing a high stakes game. They are investing heavily to capture market share in sectors like truck accessories and clean energy solutions. The good news is their core product line, the hard tonneau covers, seems to be resonating with the market, and their efficiency is improving. The challenges lie in Man, aging their expenses effectively to convert that growing revenue and gross profit into actual net profit, and ensuring they can either continue to secure financing or generate enough cash from selling their products to sustain operations. The fact that they are expanding into new product areas like solar covers and portable power systems is ambitious and could be lucre. T. Vive if executed well, but it also adds complexity and financial risk, so is Worksport a company to watch? Yes, but with a very close eye on their cash burn and their ability to translate sales growth into actual profits, and not just larger losses. Don't forget to share your thoughts on Worksport's financial health in the comments below. Did you see anything else in this report that stood out to you? Hit that like button if you found this breakdown helpful. Consider subscribing for more corporate deep dives and join our Discord community via the link in the description to keep the conversation going. Thanks for watching, and we'll see you in the next one.